Good morning, good morning, everybody, and welcome to Columbus, Indiana. We're always thrilled, and part of our pattern here is to kick things off with an economic overview. That being said, if brevity is the soul of wit, and if economists are known for not saying in 6 words what they can say in 60, we're going to keep the introductions brief, and we're going to turn it over to our distinguished panel here. So in the way of brief introductions, we are honored to have a guest from PNC Financial, Dr. Abe Omokunbi. He will kick things off by talking to us about the PNC overview for the way the economy is working, fiscal and monetary issues, and with a particular focus on regional. Then we're going to turn to some home cooking. Dr. Sam Kahan. Sam is our ACT research economist, and Sam will explore also the ACT, excuse me, we're branding here, I forgot. We are no longer ACT research, we are ACT research. So our ACT research economist will talk about his views on the overall macroeconomy, monetary policy, fiscal policy, and other interesting aspects. And then I will wrap up with a very brief overview on some of the topics that have not been covered by other speakers, or at least maybe in a little bit more depth. Issues of international, what's going on in the capital goods picture, and since the R word seems to be in play these days, what's going on with regard to recession prospects over the next year or two or beyond that. So with that, Abe, why don't you take over, and the podium and the mic is yours.
Thanks for having me, guys. It's my first ACT seminar too, so I appreciate the opportunity to present. So the U.S. economy is in very solid shape. The fundamentals of the economy continue to remain strong. Consumer spending is solid. Wage growth is also solid. So before I talk about what to expect in So before I talk about what to expect in 2019, I'd like to talk about a few points from 2018. We experienced growth at the fastest pace in 5 years in 2018. So the growth in the second quarter of 2018 was 4.2%. The growth in the third quarter was 3.4%. And the growth in the fourth quarter was 2.6%. All in, the growth in 2018 was 2.9%. So this was a very solid number. We also experienced historically low levels of unemployment. So the unemployment rate in October and November of 2018 was 3.7. So this was the lowest since 1969. So it's a very tight labor market, which means there are more jobs than potential workers. We also experienced record high corporate profits and solid consumer spending. So consumer spending makes up about 70% of GDP. So whenever consumers are spending at a solid clip, it means the economy has a good chance of moving forward. So consumer spending has been very solid. So what should we expect in 2019? So we're currently in the second longest expansion on record. This expansion started in June 2009, right after the Great Recession, which, as you all know, was the worst recession since the Great Depression. So we'll need this expansion to continue to July of this year in order to break the current record. And I'm not sure about you, but I like breaking records, so I'm looking forward to it. Something else to keep in mind is the federal deficit. So the fiscal deficit for 2018 was $779 billion. Projections are that number will reach $1 trillion either this year or early next year. The trade war. There have been lots of negotiations and conversations between the U.S. and China the U.S. imposed about $250 billion worth of tariffs on Chinese imported goods. As long as those conversations and negotiations continue, it's going to create uncertainty in the economy. But hopefully cooler heads prevail and we can reach a resolution sooner than later. We're also going to see weakening effects of fiscal policy. So the tax cuts bill was passed late 2017. What we're going to see in 2019 is that the effects of the fiscal policy are going to be much weaker than we experienced in 2018. We're also going to experience slowing global growth. The International Monetary Fund projected that global growth is going to be 3.5% this year. The World Bank projected that it's going to be 2.9%, so it's a general consensus that growth is going to be much slower than it was last year. We're also experiencing decreasing inflation pressures. So there was a decline in energy prices late last year. That has continued into this year, and that has put the Fed in a position where they really don't have to apply any monetary policy tools anytime soon because inflation is low. So talking about slowing global growth, this is a chart of the world. The red part shows the parts that are in recession. The blue part shows the parts that are in recovery. The green part shows the parts that are in expansion. And the orange part shows the parts that are at risk. What you can see here is that for most of North America, Canada, and the US, we're still in an expansion. Looking at the UK, you can see the UK is at risk. This is due to Brexit and Brextension. As long as those talks continue to go on, it's going to continue to remain at risk. But globally, growth is much slower than it was last year. So the National Bureau of Economic Research defines the start and end dates of recessions. So based on their definitions, these are the recessions we've had since 1930. So recessions are caused by imbalances in the economy. The recession in 2008 was caused by imbalance in the subprime mortgage market, and that eventually spread to the financial markets. The recession in 2001 was caused by the tech bubble. There was an increase in the price of tech stocks, and that eventually led to a crash. Recession in 1991 was caused by the 7-in loans crisis. So 7-in loans institutions issued loans to underqualified borrowers, and that eventually led to a crash. The double-dip recessions of the 80s was caused by double-digit inflation and by the Fed over-aggressively increasing interest rates. When I look at the economy today, I don't see any of these imbalances. I think the fundamentals continue to remain strong. Wage growth is solid, consumer spending is solid, and there are so many factors that make us believe that this expansion is going to continue into July. So here I have two measures of soft data. So soft data measures the way people feel about the economy. So it's usually very telling about how consumers and businesses feel about the economy. So the Consumer Confidence Index, which is the blue line, as you can see, that declined late last year. This could have been due to the decline in stock prices, but as stock prices got back up early this year, Consumer Confidence Index has gone back up. Something else I want to point to you from this chart is the election bump. As you can see, right after the election, there was a bump in both the Consumer Confidence Index and the Small Business Optimism Index. But in general, businesses and consumers feel positive about the economy, but they're not as positive as they were last year. Long-term interest rates continue to move lower. I think the 10-year was at 2.4 on Friday, the last time I checked it. So here I have two measures of interest rates. The first is the 3-month Treasury bill, which is the short-term interest rate, and the 10-year Treasury bond, which is a long-term interest rate. And what you can see from the 3-month Treasury bill is as the Fed has increased rates since December 2015, the 3-month Treasury bill has also increased in tandem. So the 3 months now is at about 2.4%, but the 10-year has declined to about 2.4 as of Friday. So the decline in the 10-year is due to reduced growth expectations. So investors and consumers don't expect the economy to continue growing at the same pace it was growing in previous years. And the markets have calmed down in 2019 relative to where they were last year. So looking at the blue bar is the returns of the Standard & Poor's Index, and the orange line is the VIX Index. What you can see from the blue bar is that, looking back at where we were in January 2015, markets have done pretty well. Yes, we experienced a decline late last year, but just considering where we were in January 2015, it's still been a very healthy market. Volatility was abnormally low in 2017, but it's back up. There's so many headwinds right now from Brexit and trade tariffs in China, and we expect volatility to continue remaining high for the rest of the year. So job growth has also been very solid during this expansion. So the job numbers for February were a little bit underwhelming, 20,000 jobs in the US. We expect there's going to be a rebound in coming months. But looking at this chart, you can see that most of the job growth has been driven by private companies. So the green bar is for private companies, the red bar is for government jobs, orange is for manufacturing and mining, and blue is for retail. So what you see here is most of the job growth is from private companies. Something else I want you to see is the Amazon effect. So look at the retail jobs, the blue bars. As you can see, over time, from 2017 to where we are now, there's job growth in retail has been pretty much close to zero. So as consumers have changed their preferences from going to the mall to shopping online, we've seen a decrease in retail jobs. Something else I want to point to you from this chart is the decline in manufacturing and mining. So if you see the orange bar in 2015 to 2017, there was a decline in energy prices, which created a slowdown. And you can see there was a decline in manufacturing and mining jobs between 2015 and 2017. So putting it all together, strong wage growth, 3% year over year, strong consumer spending. Consumers have been doing pretty well. So this graph shows consumer spending and personal disposable income. As you can see from 2014, it's been pretty solid. There's been a positive change year over year since 2014. And something else I want you to notice from this chart is that both personal disposable income and consumer spending have been growing in tandem. So if I showed you this chart in 2008, you would have seen that we were spending way more than we were bringing in. But both trends are pretty much moving in tandem. So that shows that this expansion is very steady and sustainable. So the energy production is unlikely to last, but low prices are usually good in the long run for consumers. So looking at this chart, you see the supply of oil and gas, which is the blue bar, and the price of natural gas. So I'm just going to throw a question out. What happens in any market if there is an increase in supply? What does that do to prices? Prices go down, thank you. So looking at 2005, looking at the blue bar, due to the shale revolution and hydraulic fracking, there's been an domestic increase in the supply of oil and gas. And as we've experienced those increases, we've seen the price of gas has gone down. So if you look at, I'll just show you where it is because this pointer isn't working. So as the supply has increased, natural gas price has gone down, which is good news for consumers in the long run. It means consumers can use a larger share of their income to buy other things besides gas. So as I mentioned earlier, the wage growth has been very solid. It's been 3% year over year because it's a very tight labor market. So as wage growth has been solid year over year, consumers have more money to spend. So this graph shows the quit rates as a percentage of employment. So the quit rates is the percentage of folks that quit their jobs every month. And the orange line shows the private sector wages percentage change year over year, which is wage growth. So what you can see here is that folks were quitting their jobs at about 2.3% in 2002. It went down to about 1.3% during the recession. If there's anything I can leave you with from this seminar, do not quit your job during a recession. It's not a good idea. It's back up to at about 2.2% now. So as wage growth has been very solid, and job seekers have options. The quit rates has gone up, which is a good time for the economy. It means we have more options now. We also see that consumers are willing to take on more debt. We have more capacity to take on debt. So this graph shows the mortgage debt service ratio, which is the share of your income you use to pay your mortgage, and the financial obligations ratio, which is the share of your income which you use to pay your financial obligations. So financial obligations include your property taxes, your credit card loans, your rents, and so on. So what you can see for these two ratios is they're at historic lows, looking back at where we were in 1990. So the mortgage debt service ratio is close to 4.2% now. It was about 6% in 1990. It was elevated during the recession and right before the recession. The same goes for the financial obligations ratio. Both are very low levels, so there's no reason to think we're taking on too much debt. I mean, looking at those ratios, those levels are very sustainable. And home building continues to improve with lower mortgage rates. So the 10-year mirrors the mortgage rates. So as the 10-year goes down, mortgage rates also go down. So the home building industry was particularly weak last year due to a few reasons. First, it was a very tight labor market. Secondly, the tax deductions folks were getting from buying homes aren't present anymore due to the tax bill that was passed in late 2017. But as the 10-year has gone down, and as if that remains the case for the rest of the year, we expect home building to make a rebound early this year. And we also see that tariffs wouldn't do much to reduce the trade deficit. So you can think of the trade balance as savings minus your investment. So in order to fix our trade balance, our trade deficit, we need to make sure we're taking care of what's happening at home. And what do I mean by that? So this graph shows the net lending and net borrowing as a percentage of GDP. The green bar shows government net lending or borrowing. The orange bar shows domestic businesses, and the blue bar shows households. So for the bars above zero, it means the agencies are net lenders. So if you can look closely at this chart, you can see that households and domestic businesses have been net lenders since 1980. But looking at the bottom of the chart, the budget deficit has been, pretty high, and it's been consistently the case since 1980. So the government has been a net borrower since 1980. So in order for us to reduce the trade deficit, we need to come up with ways to reduce the budget deficit. Tariffs will change the components of the trade deficit, but it wouldn't reduce the trade deficit. There's also been slow recovery in business investments. So one of the main talking points from the tax cuts in 2017 was that it's going to spur business investment. And what we're seeing from our data is that the recovery has been particularly slow. So the recovery in equipment, structures, and intellectual property has been slower than expected. So this is something else that has been a little bit troubling in recent times. So the tax cuts have also had a strong budget impact on consumers, businesses, and international businesses. International businesses are businesses that get most of the revenue from overseas. So think about Apple, Coca-Cola. As you can see, the budget impact has been good for personal and small businesses. They've saved a lot of money. So the estimates for 2018 was $150 billion. The estimates for 2019 is about the same, and that's going to decrease going into 2022. But international businesses, which are businesses who generate most of their revenue from overseas, actually are using most of the tax cuts for either stock buybacks or to increase dividends. So there hasn't really been that much of a budget impact for these international businesses. So another potential stimulant of economic growth in this year is the increase in discretionary spending caps. So the projected increase is going to be about $145 billion this year, which is fiscal policy. It's going to be at about $155 billion. It's about $145 billion last year and $155 billion this year. So as the government increases its spending, it's going to buy goods and services, which is going to stimulate economic growth. So as I mentioned earlier, acceleration in growth has been pretty solid the past few years. Gross domestic products, gross domestic income, and final sales of domestic products have all been moving in tandem. You can see the large decline during the recession, but it's been pretty steady since 2015. So the Fed has a dual mandate. The first is full employment. This means anyone who has the right skills and who wants a job will get a job. And the second is price stability, which is inflation near the Fed's 2% objective. This chart shows two different measures of inflation. First is total inflation, overall inflation, which is the orange line, and the blue line is core inflation. So this excludes food and energy prices because they're very volatile. So as I mentioned in my earlier slides, inflation has been particularly low. These are quarterly numbers. If you look at the fourth quarter of 2018, inflation was below 2%, and we don't anticipate inflation going back to 2% to later this year or early 2020. So this has given the Fed more breathing room. I mean, the Fed announced last week that they're not going to increase rates this year. I mean, this was different from what they had said previously, where they said we're going to increase rates twice this year. So the Fed has more of a breathing room, can take more of a wait-and-see approach, and be more patient in applying monetary policy. But we need to watch out for the yield curve. As most of you know, the yield curve inverted on Friday. The yield curve is the difference between the 10-year and the 3-month. I mean, you would expect the 10-year to yield more because of the term premium, because of the longer time. But over time, what we've seen is that an inversion of the yield curve has signaled a recession most of the time. So going back to the 1950s, Going back to the 1950s, almost every time there was an inversion in the yield curve, there was a recession 6 months to 2 years after. There was an inversion on Friday, as I mentioned, between the 3-month and the 10-year. And unfortunately, I'm not able to tell you if that's signaling a recession this time, because we have to wait 6 months to 2 years after. I wish I could tell you it definitely means there's going to be a recession, but we have to wait and see what the inversion actually means. So looking forward into 2019, we expect the economy to go past full employment. The unemployment rate is currently 3.8% now. We expect that number to even go further down to 3.4% towards the end of this year, and then go back up in 2020. We also expect the GDP percentage change to keep going down towards the end of this year and 2020. So looking back at where we were this time last year, the green parts of the chart shows strong expansion, while the less green shows weak expansion or recovery. You can see most of the weak areas in early 2018 were the energy producing states. Taking it to where we are now, there's more broad-based growth. So you have growth that's more spread, all over the country. And looking forward for the next 6 months, we expect even stronger growth. So we expect this growth to continue into 2019 and to go past July, as I mentioned earlier. So looking forward, there are a few risks that are to the downside. The first is President Trump. I'll let you decide if that's an upside or downside risk. That's up to you. The stock market, the trade war, monetary policy and interest rates. If the Fed all of a sudden wants to increase rates again, and if that's too aggressive, that may have an impact on the economy. The budget deficit, which Sam is going to talk about more, and also Brexit. And that's it for me. I'll pass it over to Sam.
We've decided to hold the questions till after all the presentations come out, so we can kind of do that. Oh, sorry. Let's do this again. Good morning, everybody. All right. We're going to hold all the questions till after all the speakers come about, so we can kind of consolidate things and give us all a chance to pontificate to the captive audience. Since I'm not technically facile with these things, I hope the slide works. And if I mention some acronym or something that you don't recognize or something, just raise your hand and I'll respond to that. Otherwise, we'll keep everything going on. My speech is going to be quite short. I agree with everything that the previous speaker said, and I also agree with what the next speaker is going to say. So, quick overview. The overview of the economy is that 2018 was strong. For those that don't speak economics, it was probably the icing on the cake or the best in a long, long time. The numbers are there as well as our forecast for the next couple of years. We think that the stimulus that took place in 2018 is going to deteriorate and we're going to have a deceleration. Now, a deceleration doesn't mean that things are bad, they're just not as good as they were before. For those of you who like to drive fast, if the speed limit is 65 miles an hour and you're going 90 miles an hour and you slow down to 80, you've slowed down, but your probability of getting a ticket, a speeding ticket, is still high. And I think that's the image I have of the economy looking forward. It's slowing down, but it's not negative. And I think that's important. The unemployment rate you have over there. The key discussion that seems to have arisen in the last week, more so than before, I still think that the probability of a recession, or if you want, the possibility that a recession will occur is relatively low, but higher than it was before, but certainly not a done deal. As we've argued for the last year and a half or even 2 years, that pockets of weakness in particular industries we think is very likely, but we don't think, we think that the probability of it percolating throughout the economy is not that great. And what we use is an old term that Ed Yardeni used back in the 1980s of a rolling recession. And the candidates for that are, unfortunately, manufacturing, retail, possibly energy, and the new one on the list, but with a low probability, is the housing sector. In terms of inflation, what's been interesting about inflation is that prices of inflation, while the Fed prefers seeing it around 2%, we really have been struggling to get to that time period. Looking forward, the printed numbers are likely to be on the low side, mainly because of the relatively low energy prices. We're all talking about WTI being someplace in the 50, I think right now close to $60, but that's a mere 6 months ago. We were worried about it having triple digits. So that's going to have an impact for a year or two in comparisons of that form. Again, on wages, we see wages rising. The latest numbers show us about 3.3 or 3.4 on a year-over-year basis. Relative to where a full employment economy is, that's still relatively low. So higher wages, but they don't seem to be percolating, or have not yet seemed to be percolating to the overall economy. And what's most fascinating to me is over the last 3 or 4 months, the public's measurement of expected inflation, whether through the financial market manipulation of the numbers or surveys, have shown that people's expectations of future inflation have been coming down and not up. And that was one of the conflicts I think that the Fed had. So what will happen to interest rates? Because of a couple of things that I'll talk about soon, the economic picture is very mixed. And you saw the volatility index that was shown before on that point. And I think the important part in that is that the Federal Reserve, in weighing the risks of the economy between high inflation versus a slowing economy, the Federal Reserve has decided that the risks of having a recession, or the costs of incurring a recession, are much higher than incurring higher inflation, and so they've shifted their policy to take that into account. It does not mean that they are sure a recession is coming. It does not mean that they're confident that we don't have inflation, but it's just a simply weighing of the two. So let's go take a look at the details. All right, quick picture. I think you're all familiar with it. The blue solid, squares or rectangles are historical growth of real GDP on a quarterly basis. On the right side, are the famous colors. The dotted red line is the ACT forecast, the ACT forecast, of economic activity. And the top brown and the bottom green line are the forecasts, the highs and lows as taken from the blue chip consensus. You can see that we're kind of closer to the optimistic part for this year, 2019, and we turn a little bit more pessimistic than the optimists before that. And the real pessimists think economy is really going to slide down, but then by 2020, it kind of reverses a little bit from that area that we had before. I think that the most important part, the takeaway, is that things are going to slow down relative to 2018, but even the consensus, even the pessimistic consensus is not looking for a recession. We're coming slow growth and stuff of that sort. In terms of the components, as Dr. Obama pointed out, the strong area is going to be consumption. The weak area will probably be the trade deficit, and the money decision will be what will happen to the animal spirits or what will happen to fixed business investment, which is actually driven by optimism and things of that sort. In terms of the areas that are near and dear to all of us, this is a chart of the growth in the sectors that drive transportation and freight. The dashed dark line is the overall economy. The green line is the growth of hold on. Sorry. It's been a while since I looked at the color codes. The green line is the goods producing areas, that's manufacturing, construction, and mining, that drives overall. And you can see it had been building up steam through 2018, and in the last 3 quarters it has slowed down. These numbers are quarterly rates annualized, except for trucking, which is because of the volatility I put on a year-over-year basis. You can see that manufacturing, again, has picked up as the economy rose, and then in the last 3 quarters, it has slowed down, as we've seen. And finally, if you take a look, trucking, which is the red line, has been picking up and has slowed down with a lag as the overall activity has come down. But in all these things, again, it's not negative growth, it's just less good as it was before, or using our analogy of driving, we've gone from 95 miles an hour down to 80 miles an hour, but we're still advancing. All right, picture of manufacturing or industrial production tells you the same story. Again, 2018 was a great time. We're in the process of slowing down. And the real question is going to be, how much of a slowdown are we going to get and for how long? And our forecast is we take it down from roughly the 2% average of the last decade, and that's considerably slower than the 4% or so that we've had last year. And for lack of anything better, we create a plateau at 1%, 1.5%. Now, could it get worse than that? It could, but looking at most of the risks, a reasonable flattening out or plateauing around 1.5 seems a little bit more reasonable. So switching gears to inflation, same charts that you saw before in terms of the volatility. The red line shows you the overall headline. The green line shows you excluding food and energy. And you can see that the energy is pushing the forecast down the dashed line to around 1.5%, well below the 2%, and then we move up towards the 2%. And the big debate or the unknown is, are we going to go above the 2% and stay there, or are we going to go down? Again, the takeaway from all of this is we're not going to go from below 2% to 4, 5, 6, 7, or 8, but we're talking about fractions of a whole percentage point. Looking into 2020 or 2021, as the impact of the energy whittles away, we're going to go up to that 2% or a little bit above that as the outlook for all of these things. And those are these are our forecasts and the unknowns.
I'd like to take one minute for a housekeeping detail. We have an array of arrivals just come in for our program. If there are open seats available in the front row, and those who have an open
And don't be bashful.
Don't be bashful. It's not church and you don't fight.
And there is no plate.
Hey, Jim, they can join me over here.
That's right. That's terrific to sit next to.
Okay. So, no problem at all. Everybody okay? Terrific. Again, the point in here is that 2% seems to be the benchmark to take a look at, and there's a lot of uncertainty about it. The takeaways are, number one, we really have not been at that 2% mark despite what the Fed has, and the forecasts for most of them are that we'll be someplace around that, either up or down, and that's the pivot point looking into the future. All right. Here are a couple of things in terms of the current environment that we have to take a look at that causes a lot of uncertainty and I think has led the Fed to kind of stop and smell the coffee, so to speak, or for those of you who speak Fedese, they use the word patience. Now, that doesn't mean that they know what the future is going to be, but they're looking at what they're seeing and it's really confusing to them. And I'll share with you, it's confusing not just to the Fed, but it is, but please, this is one of those proprietary things that you cannot tell anybody else. Sam Kahan is also confused, so, but don't share that outside this room. In terms of the things, there's been a divergence in what the economic numbers were saying relative to what we thought they would be saying, but also internally, the different sources for the same information are telling us two different stories. For example, retail sales. If you read the newspapers as we're coming to Christmas and post-Christmas, everything was great. Benchmarks were made, profits were galore, and then the official numbers come out and tell us that October sales are great, November sales were great, and somebody stole Christmas. Retail sales went down 1.5%. And the question is, who was telling you the real story on that? And when January numbers came out, they didn't revise the old numbers. They said, we're a little bit better than we were in December, but we're still down depending how you put the numbers together. So how does one square that? If you think that was just an aberration, well, we get the employment numbers. At the end of 2018, we get 300,000 one month, another 300,000 the next month, another 300,000 the next month. Now, admittedly, they revised those things in the following month and said, you know, it wasn't really 300,000, it was 200,000. But 200,000 is nothing to cry home to mom about. And then comes the February employment, and they're up 20,000. So which is it? And if you think that's enough, the one that has been a real head-scratcher for us is we get reports, good, strong employment number in manufacturing. We get a good ISM, or if you don't like ISM, you get a good market number, and everything's good. And then the Federal Reserve puts out the industrial production numbers, and you get a weak number. And I'm sure one of you will say, well, that was all weather-related because of utilities. Well, if you look at manufacturing, employment's up 50,000 for 1 month, and the Fed thinks we lost 1% of output in manufacturing. So when you have all of those kinds of things going on, giving you conflicting stories, the smart thing to do is take a deep breath and take a look and see what's going on in all of those things. Now, there are many different explanations for each of these. It could be partially because of the slowdown, partially it's seasonal adjustment problems, or it could be a turning and inflection point. And so the question really is, do you look at each number separately? Do you look at the average of all of these things? And there are different explanations for each of these that you can kind of come along with. And that's why not only the Fed, but I think the people who are smart take a deep breath and try to evaluate this. And this volatility is going to continue for another couple of months in here. Part of it has to do with how the economy is reacting to the overbuilt, to the large buildup of inventories. Manufacturing is a little less clear. Some have argued that fears about tariffs, the uncertainty of trading, or the uncertainty of the generality. So that's one good reason for why things are slowing down. If we switch gears a little bit and take a look at the energy market, as you saw before, its movement is going to be critical to understanding how inflation comes about, but also overall economics. I'm going to give you a kind of a quick scenario of what's going on there. As we all know from those of us who either went to economics courses or slept through them, the key element is always price, and how is price determined is the interplay between supply and demand. On the top line over here, I have for you what was the estimated demand in millions of barrels per day worldwide, which was in 2016, 95. As the economy has grown, we've moved up to 99 million. Actually, the forecast a year or 2 years ago was that it would be about 100 to 101, but the slowing of the economy, of the world economy from a super hot rate of 3.8, 3.9, which has now been lowered to around 3.5, 3.4, depending who you want to pick, has moved it down to about 99. If we take a look at the supply side, and it's not just the U.S. shale production, you can see how the amount of available supply has increased, but the gap between the two has been about 31 million. Now, the key filler between all of those has been OPEC and things of that sort. Now, OPEC has been able to produce, depending on how fast each of the components goes, anywhere from 33 to 34 million dollars, 33 to 32 million barrels a day, but under the pressure of the Saudis and the encouragement from Russia and others, they've been able to reduce it to prevent a collapse in energy prices. And right now, they're trying to keep the production level at about 31 million barrels to get us into balance. But how to do that is very difficult. And essentially, because you have to have an agreement between the various producers not to produce as much as they want to. And there's this balance between the two on how to make sure that prices don't collapse if everybody produces. On the other hand, to prevent the prices from going up too fast, too far, too fast, because the higher it is, the more encouragement there will be for U.S. shale production, Canadian shale production, and some other countries. So we have a little bit of a component on that. If you look at the bottom, I show you what are some of the parameters in getting into it. Number one, what I would call the sick countries, Venezuela, Nigeria, Libya being the three major ones, are essentially having problems to produce anything, and the headlines tell you how much it is. And you can see what their current production is on the left side, and the right side gives you the range of where the overall production is. The big question is what's going to happen to Iran? Now, Iran has the capacity, has over the last year or so, because of sanctions and other problems, has reduced its production to about 2.7 million. And last 6 months ago or so, the President Trump allowed an exemption for about 8 countries that were not susceptible to the sanctions. That exemption is going to expire next month in April. And the tough question is, will it continue, in which case Iran will be able to continue producing at around this 2.5, 2.7 billion area. If the exemption is not extended, then there's going to be an enormous decline in the ability of Iran to sell its product legally. And the estimates are that could reduce Iran's output by as much as 1 million barrels a day. Now, as I pointed out, there's very little hope for an increase from the other countries, the Venezuelans and the others. And the question strategically is, do Russia, Saudi Arabia, and some of the others increase their output to match this balance? Well, if they do that, then the whole idea of restricting the output from the 33 million down to the 31 becomes a little bit of a problem in how to control it. But if they don't do that, the consequence will be rising prices, and maybe very high prices, which then has all kinds of strategic problems. So how to play that game is one of the challenges. And in fact, in the last week or so, if you're reading in the papers, people seem to be scratching their heads as to why energy prices are going up when all these estimates are of weakening global economic news and worsening problems in the United States. And I think it's simply a political question of will sanctions be imposed or not. And that's more of a problem for the next month or so. So that's the dynamics of the energy prices. And if we do have the exemptions continue, then should see the prices come down somewhat. I don't see them collapsing for a whole host of reasons, but remaining in that $50 to $60 range with maybe a couple of deviations, principally in September being the one. And this is kind of a summary of what I've just said before. You can read it and all of that stuff. Two other things about the energy prices that I think are important is, number one, starting in January of 2020, the International Monetary Organization has not recommended, has passed an indictment or a requirement, an edict, a requirement that the sulfur content of ships be reduced from roughly 2.8% down to about half of 1%, which means that they have to change their fuel characteristics. And technically, what it means is that demand for diesel type or low sulfur activity is going to soar. And the question has been, will there be enough of a supply or substitutes around to prevent the prices from skyrocketing? And there are people out there that are thinking that diesel prices, which in the United States are around $3 or so a gallon right now, would soar to 8, 9, whatever number somebody has if they didn't have a good breakfast involved. So it's something that will start taking into effect in January. And talking to the people in the area, it doesn't look like that the requirement will be changed. So the question is, what will happen to those prices? And I think in the next 9 months, we'll hear more and more about that. Maybe by nature, I'm an optimist, but I have a lot of faith in the system. I don't think we're going to have dramatic dislocations that will come about. We might see some increases in diesel prices for a year or so as the alternatives are gotten, as the refinery structure and the supply chains adjust to this new, different demand, but it's not going to be helter-skelter in that process. More importantly is historically the spread between gasoline and diesel, not historically, recently, over the last year or so, that spread has widened out. Now, the spread between gasoline and diesel has some technical things in it, but also some seasonals. The spread between gasoline and diesel over the last 5 years or so has been about 20 to 30 cents per gallon. In the last year, that has widened out to about 60, 65 cents recently. Now, part of that is due to seasonal factors. That is, diesel competes with heating oil and things of that sort, so the spread between gasoline and diesel on a seasonal basis tends to widen out sometime around November, a little October into March, and then it collapses as the demand for heating oil dissipates. Now, on top of that, the United States government has allowed exports of energy or of oil to the rest of the world. As that has happened, the diesel prices overseas have tended to be higher than the United States, so there's been an encouragement or an incentive for exporting that. So part of the widening spread has been a new market of exports and things of that sort. So right now, or let's say at the end of December, the spread between gasoline and diesel was about 80 cents. Part of that is this heating oil phenomenon, which is going to squeeze down, but the export will remain. So instead of having a 20 to 25 cent differential between gasoline and diesel that we've experienced in the past, it's probably going to widen out to around that 30 to $40 cent differential to reflect the exports. Now, this ISM may obviously increase it a little bit more temporarily for a year or so as the adjustment takes place over that IMO. Finally, one of the things that always surprised me is why we haven't increased the federal tax on fuel, but there's more and more discussion of that, and we're seeing more and more of that occurring on the state and local area phenomena. Indiana is a good example of that, and there's a whole bunch of others which will obviously affect the price to some extent. And here's a chart just tells you all the same thing, and you can see historically how it's widened out. The last hook on the bottom on your right is simply the diminution of the seasonal element coming aboard. All right, now our favorite topic, the Federal Reserve. You see the rising trend, which now they said they're going to hold, or his assumption is that it's going to hold for a while, but we're not over. Number one, as I said before, the Fed doesn't know what the future is going to be, but it's trying to analyze all of the things that we have. The conflict, again, is between the possibility of recession versus inflation, but there's still a potential for debate. One is, what is exactly the right interest rate given the state of the economy? And the truth is, most forecasts, now there are all kinds of numbers, but most of the forecasts of the correct funds rate will be someplace between 2.5 or 2 3/4 to 3.5, 3 3/4, and we're below that area. So if we were looking into the future, if we were to see the economy slow down, or let's take the other side, the economy accelerating somewhat here without inflation, there may be more of an internal debate as to are interest rates just right, or are interest rates too low, and should we continue moving up? And I would not be surprised if you have the president of the Federal Reserve of blankety blank coming along and saying, well, I still see rates going up, and I can see somebody else saying, well, rates should stay over here. And what they're actually arguing about is that little box that we had here. What's the right number for all of this? And everybody's going to be influenced by the flow of the numbers. And as I pointed out before, looking for the near term, we're going to have some problems as to deciding or deciphering what the numbers mean. The disaster for me, in terms of the Federal Reserve, is going to be the June to September period. And by June, we should have a pretty good idea of disentangling all of the numbers or figuring out what they're going to do. In September, our the federal fiscal year ends. That is October 1, we need a new budget. Looking at what's in Washington, to me, the probability of any kind of coherent budget passed is very, very low. So I can see us having the typical problems that we saw just now in December, that we've seen in 2011, 2013, 2015. It seems to be every 2 years we have a whole argument of how much to spend. On top of that, the debt ceiling, which was put in abeyance, so was discount, is now back in play. Now, it's not going to have an actual effect until the federal, because the Treasury can play all kinds of games. It doesn't allow for certain technical purchases or stuff like that. The crunch will come. Anybody want to guess when the crunch on the debt ceiling is going to come about? I'll give you a hint. September 30th, which is the end of the fiscal year, which is precisely the time period when we have that. And if we have the Federal Reserve, the economy picking up or not picking up, what does the Fed do in that kind of an environment? Let's say we have very weak economic numbers. Does the Fed ease rates in that kind of environment? And conversely, what if we have a pickup in inflation? Does the Fed increase rates? So all of these things, I think, is going to come, or more so in this time period than any other period that we have looking forward. Now, everybody's talking about recessions. I think there are a couple of things to say about that that are important. In my opinion, recessions don't come on a schedule. They're not like dog years or anything like that, but they're a mistake, either by the Fed or some shock to the system that comes about. There are all kinds of signals for it. Today, everybody is putting their money on the inverted yield curve. Number one, how you measure the yield curve is a big debate, and I personally do not think that the 3-month to the 10-year is the valid one. For those of you who are old, and probably Ken, Jim, and myself, there was a time when they looked at the yield curve not at 2 to 10, but they looked at it 2 to 30. Maybe we should look at it at 2 to 2.5 year. I don't know. You know, that comes about how long these things are there. And most importantly is that most of the things don't tell you about one number. Remember, the inverted yield curve is simply a financial measurement. What we want to know is what's going on in the whole economy. That's why the typical kind of popular index of economic activity includes measurements of employment, production, equities, and all the rest of those kinds of things. So, and most importantly, it's not a binary system, that is, recession or no recession. I think the right way of assessing these things is to ask ourselves, what is the probability of something? So, again, I think the probability is low, not as low as it was 2 years ago. It's still below 50% and is more likely, is rising. And ultimately, the decision depends on each company's personal outlook on what are the consequences of an economy slowing down, what are the potential gains of ignoring it, and what are the consequences of not ignoring it. What we do think is likely is what I called before rolling recessions, meaning weakness in manufacturing, retail, and how to explain the housing area as ones. Economists never sleep. I sleep with one eye open. What I worry about is what if I'm right and we do have a recession in manufacturing, in retail, in energy, and in housing? Will all of those combine and then lead to an economy-wide slowdown? But I don't think that's likely to happen. And just to make you guys feel good, here's a partial list of all the things that you should be worried about and the risks. I think we had a point on that. But my dad told me, never end on a negative note. You know, America is one of the greatest countries in the world. We are all optimists, and here's my version of the whole thing. First, a disclaimer. Blame it on technology. Look at the chart, and I'll define it in a minute. On the right side, on the bottom, it says 1956 to 2017. I tried to change that to 18, but my computer refused to let me change to that number on those two. So the number all the way on the right is correct, but it's for the period through 2018 and not 2017. Now, what is this telling us? This is a picture of productivity growth, both year over year in percentage terms and a longer five-year average. The red lines are the year over year. And I'll draw your attention, and on the right side are growth calculated in real numbers by decades, 1960s, 70s, and so forth and so on. You can see that the growth rate has slowed down in the 21st century, and growth of productivity is an important part of the process. If you, let me draw you to the graph on the right. What you'll see is something that's very interesting, that in the last year, growth has moved up from approximately 1% to approaching 2%. Now, normally as a cycle matures, what happens is actually productivity slows down, and there's a whole host of reasons for it. The question is this a mismeasurement that we're seeing recently? Is it an aberration? Or is there some kind of growth coming along in that businesses are much more cautious about how they invest in either people or capital, and maybe the slowdown that was coming because of all the forces may be offset by this productivity? The answer is I don't know, but at least we have something to feel good about as we hear the other conversations. And I think that's about all, and let me turn it over to Jim at this point.
Good morning, everybody. Hockey fans are getting excited over the prospects of the NHL playoffs and Stanley Cup in the offing, so I decided to pick up the theme and see if we could score a hat trick. That means 3 goals. Over the course of half a period, that means 10 minutes. So let's see, what are our 3 goals? Over the next 10 minutes, let's talk a little bit about the international situation. Abby made mention of it. I have a few slides on it. We do have a global situation that is making us doing a little bit of head scratching here. We can see a slowdown in China, definitely a slowdown in Europe, even in Japan and even in North America, which have been bulwarks for the global economy. We're seeing some signs that some of the prosperity is going in a little bit of a different direction. So we'll talk about that. the European Union might be on the verge of an industrial slump. That is an out-and-out year-over-year decline. Sam might call it a rolling recession, a mini recession, but there seem to be some danger signals there. And of course, Brexit is in the paper every day as they kick the football, or soccer ball, as we would say in North America, down the field. Capital goods are peaking. Many of you are aware of the fact that we're calling for a Class 8 decline next year. But if you take a look at some important adjacent sectors in, let's say, off-highway, for example, other capital goods machinery sectors, the story is somewhat the same, which is that we are peaking out and there are signs that we're going to go through a belt tightening or a correction as we work our way through the rest of this year and into 2020. So we'll talk a little bit about the evidence there. And then finally, let's talk dirty, shall we? That's intended to be humorous, but we'll skip that. We're going to talk the R word, the recession word. Let me ask this. Do we have any Generation Z representatives here, those who were born in 1995 or after? Oh, we are an old. How about late-stage Generation Y types? You were born perhaps in 1987 or after. You might be in for the first recession of your working career. What a treat. Okay, so that's what we're going to do over the next, now I think I'm down to 8.5 minutes, so I better start talking fast. Oh, okay, ACT Research's art department is giving us, nice little things like that. Some of the information that you'll see over the next few slides, we actually tweet out under these handles. So if you want some additional stuff for free, there you go. You're probably already signed up for Donald Trump's tweets, so why not get ours? Okay, so enough of that. China expects 2019 economic growth at 6% to 6.5%. Definitely a step down. Definitely the kind of things you're picking up in the headlines, and one sign of declining growth prospects in one major global player. It's not just China. The OECD, in essence the country club of industrialized countries, is also doing some marking down of their forecasts. In their very latest release in March, they're doing some belt tightening on their numbers for the global economy. So this came out at the beginning of this month, and it's one thing to see the headlines. It's another thing to actually look at the numbers. And my apologies for the fact that this is a little bit of an eye chart. But I think the takeaway, above and beyond just looking at each one of these numbers, is to see that there's a step down in terms of the OECD forecast growth, not only on a year-to-year basis, that is to say 2019 and 2020 are going to be slower than our banner year last year, but also the difference pointed out directionally with the arrows between what they were saying and what they were thinking in November of last year, and what a difference that just 3 months makes. So the OECD, the global wizards of economic forecasting that put out their forecast for free, thank you, do have a less upbeat view of the world. So there are signs of a global economic slowdown. Now we put together this chart, which I hope you find as interesting as we do, which is the market purchasing managers' numbers that are assembled and published at the beginning of each month. And basically this gives us a very nice snapshot of what's going on in the global manufacturing sector based on this purchasing manager survey. Many of you are probably familiar with what these surveys do, which is purchasing managers, who are usually very smart guys and gals and have their finger on the pulse of their companies, are surveyed once a month, and basically they give a thumbs up or thumbs down approval rating on the prospect of their companies. So this is assembled by a group called Market. They publish it, and it's a pretty easy kind of diffusion index to understand, which is, in essence, if the number's above 50, you're growing. If the number's below 50, you're not growing. But we sort of take one more step, and we say if it's above 54, that means you're going to grow above trend. if it's below 51, you're probably going to grow at less than trend, and if it's in the 45 area, that's recessionary. And as opposed to looking at any individual number here, I'd suggest taking a look at the sweep of the global coverage we have here. If you take a look at the way the world was working last year, there was a whole lot of green go for it, above trend growth numbers in North America, in Europe, even in Japan. Then move your eyes from left to right, and the story is that the green starts to disappear and you start seeing yellow cover. So if you're interested, we tweet this out at the beginning of every month, and it's sort of a nice little snapshot, easy to understand, on what's going on in the world. Okay, so let's talk about capital goods for a minute or two. The thesis is that capital goods, which sustained a lot of the big growth that we had last year, might be peaking, and we might be starting to slide on the other side. And here are some of the indicators that we look to see what the story is there. This chart is put out by the Census Bureau. Your taxes pay for it, and it shows long history, in essence, 25 years of history. And if you take a look at it, I think there are 2 or 3 takeaways that you can have. Number one, note that the chart does not vector up. In essence, it's a roller coaster ride. The peaks have not changed since the late 1990s. So sort of the nasty, dirty story here is that there's not a rising trend. There's not an upward slope over the course of these 25 years. You hit a top, you go to a bottom, but you never break through to new tops. So the story, perhaps unfortunately, and granted I'll confess that this is not inflation adjusted, the story is that you seem to be caught in a trading range. In basically, the amplitudes don't reach new peaks. So not the happiest story if you're a capital goods analyst. Number two, for those of you who have terrific eyesight, you'll see that on the far right, it looks like we're rolling over. That is to say, in the total picture of non-defense capital goods, orders have reached a peak, and it looks like they might be set up for some kind of decline. Granted, the series is noisy. Granted, there are a whole lot of hiccups in the history. But it would seem to show that maybe we're topping out, and maybe we're talking about plateauing, perhaps at best, and maybe a little bit of a retrenchment if it's not so good. Recession, maybe not, but let's go on from there. Again, an adjacent sector, construction equipment, representative of what's going on off-highway. Same sort of kind of story. Here there's a little bit more of a trend from left to right. Lots of volatility, but also some visual evidence that maybe in construction, in off-highway, for a number of different reasons, we might have tapped out on this 3-year growth upward swing that we've had, and maybe it's time for a change. Though I will readily grant you the story could be the series has a lot of volatility. Just to formalize this, we actually have a little bit of fun doing some forecasting. And just like with the OEC rendering a judgment on the world and saying this year could be slower, next year slower yet, we're anticipating that 2019, after a pretty darn good 2018, might represent a little bit of belt tightening in some of these key capital goods sectors. So, keeping on pace, why is this happening? I mean, it's one thing to report the numbers. It's another thing to say what are the underlying dynamics for what's going on here. Number one, not too terribly hard to figure, a slowing economy, both domestically in the US and internationally. Number two, capacity is getting closer to being right-sized. In the wake of an accelerating economy, given the momentum of tax cuts, we found ourselves capacity short, certainly at the start of last year. Now, after a robust year, it looks like we're getting close to being right-sized with the right amount of capital stock relative to demand. Number three, interest rates are going up. For some enterprises, that means the cost of capital is going up, and therefore the hurdle rate has been recalculated and might be resulting in saying no to certain projects that were getting the thumbs up before. Number four, perhaps a greater risk perception on the part of business, and of course that would be tied to the higher cost of capital. A little bit more nervousness out there on the part of managements with regard to what the prospects for next year are going to be. And then, of course, I made mention of the fact that, tax cuts were very, very strong in terms of imparting momentum on the economy, and particularly some of the breaks that were given for investment goods last year. That's an influence still at work, but it's a diminished tailwind. Okay, so what is a recession? Silence ensued. Well, let's figure out what a recession is, but maybe we'll start with this. And again, Abbe talked about the fact that this has been a long cyclical recovery, just a few months short of setting the record. But there are two, let's say, defining characteristics that I think are brought out in this chart. Number one, if you take a look at the bottom and compare this expansion cycle to previous expansion cycles, this is, let's say, identified and perhaps notorious for the fact that it's been going on for a long time. But whether you talk about growth in a GDP context, the overall context, or talk about the manufacturing sector and what the manufacturing sector has been able to do, the growth rates are a fraction of the growth rates that characterized GDP growth in prior expansions, and particularly the manufacturing sector in prior expansions. And keep in mind that manufacturing, as a goods-producing sector, is very, very important for the generation of motor freight. So, sometimes I advise our customers and clients to take a look at these kind of numbers and sort of put them in a GPA-type context. If you have children and they bring home report cards that have 4 O's or 5 O's or something like that, those are pretty good GPAs. They get you on Dean's List and you're a rather happy camper in the family. 2.1 is probably academic probation. You start to hesitate underwriting the further educational experiences of those who bring home 2.1s. 1.3 is even worse. So the story here is that over the course of this expansion, the U.S. economy has been on academic probation. Okay. So let's go on from there. What is a recession? The common layman's definition is 2 quarters of declines in overall GDP growth. But in fact, in the U.S., and this is very important because we need to keep economics professors employed, we actually have a business cycle dating committee that tags dates on when expansions start and when expansions end. And this business cycle dating committee meets during periods of possible recession, once again keeping the professoriate employed. When they make the determination, they take a look at 2 key variables: real personal income, less transfer payments, and employment. They also take a look at industrial production and the inflation-adjusted sales volume of manufacturing and distribution, wholesale and retail. So then they have they get together, they have a confab, I think it's done by teleconference these days, and they say, yes, the expansion began on this date, the recession began on that date. So just so that you know, there's actually a formal body that meets and makes these dating determinations. And while these are the main indicators they look at, in essence, they take a look at a number of different variables. Trying to say, okay, that's great, but they make post facto determinations, which doesn't help us as business analysts very much at all. So I would suggest this, looking forward, to say, here's the kind of process that defines the stage-by-stage development of a business cycle decline. Number 1, the central bank, Federal Reserve, begins a series of interest rate increases. Number 2, borrowing rates rise. Of course, as the Fed sets interest rates higher, your banking rates start to become higher. And that produces the flat yield curve or the inverted yield curve, which we've already talked about in this forum. And what it starts to lead to is the fact that banks become a little bit more selective with regard to the quality of their loan portfolios. Translated into English, that means loans are harder to get. The credit standards increase. Overextended sectors, highly leveraged sectors, or sectors that are subject to cyclicality, like the manufacturing sector, like capital goods, are impacted more than proportionally by this credit squeeze. Then we get perhaps the final triggering event, which is some kind of shock. Often in the past, often in the last 50 years or so, it's been an oil price rise, but it's also been things like the housing slump of 10 years ago, or the Persian Gulf War that was a trigger for the 1990-1991 recession. And then you get the recession ensuing. So there's our yield curve picture. We've already talked about that. And we've already said, okay, fine, check the box on that. Because as of last Friday, no matter what your favorite yield curve benchmark is, whether it's the 10-year less the 2-year, the 10-year less the 1 year, the 10-year less the 3 months, we're there. That box is checked. Number 2, and here's where you say the next stage in this possible sequence hasn't happened yet. From both anecdotal reports and from this measure that the Federal Reserve takes of senior loan officers, we don't have a critical credit tightening situation in banking and financial markets yet. This is a survey that the Federal Reserve takes of senior bank lending officers. They do it every quarter. And you can see when the bank lending officers say, we're not making loans. Yes, indeed, we're in trouble. So it happened in 1991, happened in 2001, and happened in 2008, 2009, 3 previous dates of recession. If you take a look at the latest observation, we're sort of at the break-even, the 0 point. So is it a problem? No. But this is one metric that you might want to keep your eyes on when you take a look at the checklist, the check boxes for what stages, what kind of triggers can bring about a recession. So we've got the central bank beginning interest rates, we've got the flat yield curve, we don't yet have banks raising their credit standards yet, though something to keep our eyes on. Overextended sectors pinched by a credit squeeze, not yet. A shock, that's an unknown unknown, as Donald Rumsfeld would say. So we always have to be guarded about a shock, but they're very, very hard to predict and very, very hard to anticipate. And then we get the recession. So if you wanted to guess based upon circumstances right now, what's probably at worst 4 quarters out there, 6 quarters out there, even with that flat yield curve. But again, to acknowledge what Sam says, maybe not. Flat yield curves often lead to recessions, but it doesn't always happen. And we had a chapter, an episode in the mid-1990s where we had a flat yield curve but didn't get a mid-1990s recession. So with that, I don't know if I did 10 minutes, but we've covered this kind of turf, and now it's time for the fun part of our session, the Stump the Chump section, where you get to ask questions of us and see whether our answers are hit the mark. So with that, thank you very much. Let's begin the fun. First.
Repeat the question.
I'm sorry, we're going to get a mic. A mic would be better.
Thank you. So there's been, that's kind of loud. So there's been a good amount of speculation that the dip in retail sales in December could have been due to data collection during the government shutdown. Do you think that has any merit? And if not, can you talk a little bit about what you think caused the dip in retail sales towards the end of the year?
Okay, again, is this mic working? Okay, great. I think the data collection or the shutdown is very, very small, or maybe even, let's just say it's 0. My best explanation of this is that there's a different seasonal adjustment. The numbers that we're seeing, the pattern, no? All right, look. Okay, let's try again. It's all my fault. I told you, technology and me just don't work together. I think the problem is not the shutdown, but a different way of customers behaving. The numbers that we see are seasonally adjusted, which basically is taking a look at the pattern of buying and selling over the last 7 to 10 years, putting it through a fancy economic number called X11, X12, X13, and then getting a number. But what I think has happened over the last 2 or 3 years is that instead of people buying between Thanksgiving and Christmas, they've been buying different time periods. Part of it is the desire to have that pocketbook or that toy or that electric system and being afraid that there won't be enough of those things. Part of it is also the response of retail by changing the prices to make it more appealing to buy it before, so that the seasonal expects most of the spending to take place between Thanksgiving and Christmas, and instead it takes place in October and November. Now, that will change as new data comes in. The seasonal factor takes that into account, but it didn't do it here. And I think the best proof of that is the anecdotal evidence, and not just anecdotal, but the hard evidence from people like MasterCard and others that were reporting a completely different behavior. And so the problem is we live and die by statistics, and I don't think that it will be changed, or that information. It's possible that in May, when the retail sales are recalculated for the year, but more likely it's going to happen when the benchmark, which will be 2 or 3 years down the road. So,
Let me add just one elaboration on what Sam said. As he already cited, there are alternative retail surveys to what Census puts out, most notably the MasterCard Spending Pulse survey that characterized the holiday sales season of 2018 as the best in 5 years and one of the best of the 10-year recovery. So, yeah, I mean, it almost gets down to which source do you trust and which do you think is more definitive. Given both the government shutdown, and Census says the government shutdown did not impact the quality of their numbers. That might be the case. But retail sales is one of the more volatile and perhaps less reliable in the full spectrum of government indicator releases. And if push comes to shove, I'd say the MasterCard real-time survey of their transaction base is probably a better measure than the Census retail sales number. But again, it's one of these things where, unfortunately, when you do get times times of transition, your data benchmarks can sometimes, it's like a compass, near a magnetic field. It all of a sudden starts to give you strange readings. And we might be at a juncture where there's enough, let's say, cross currents that the kind of reliability that we hope and expect to get from our economic measures doesn't quite measure up. Way in the back.
There wasn't much discussion about tariffs. What is the perception of the tariffs' impact on the economy and going forward, or if additional tariffs are increased?
Silence ensued.
we're having an internal debate here. Number one, I think a couple of things to think about on the impact of the tariffs, both on the real side and on the inflation side. On the inflation side, it's important that the imposition of tariffs is a one-shot deal. It's not a continuous thing. So as the tariffs come about, you'll see an increase, and then once they're imposed, unless they're increased continuously, the rate of inflation goes back to its old trend or the underlying trend, number one. Number two, the real fear that I think I have about the tariffs is not what they do themselves, because we can adjust to that. It's the fear that it will then lead to other impositions of tariffs, which ultimately will affect the real side of the economy, as happened in the 1920s. So those two are the most important ones in terms of what it is. Number three, in looking at the data, I have to admit that I have tariffs have been talked a lot about, but I didn't see them really in the macro numbers as much as we've seen before.
Yeah, I'll talk about two potential impacts of tariffs. So the first is what it does to business sentiment and consumer sentiment. So just the mere fact that these discussions have been going on for so long, you know, a lot of businesses are going to be more reluctant, more hesitant in either increasing capital expenditures or, you know, merging or acquiring new businesses. So there's that impact. It's going to affect small business optimism. The second is the tariffs are going to affect supply disruptions. So these businesses are going to have to adjust, and eventually consumers are going to be the one who actually end up paying for these tariffs.
And just to add one point, I agree with Sam, we haven't seen long-term distortions yet, but for those of us who watch either the manufacturing numbers or the freight numbers, part of the impact of tariffs and tariff deadlines is inventory distortion. As you see supply chains build up in order to make provision should tariffs go into effect and should change the pricing upstream in their supply chains. So you'll see imports come in. It's a temporary rush, but what it does do is it interrupts the organic flow of supplies that come from tariff-affected areas. And then all of a sudden you get the payback period. So, you know, for those of us who are data hawks, it's distortive and it makes the overall picture that much harder to read.
Let me just add one point to what Jim just said. Most of the forecasts for first quarter 2019 GDP are very low, and part of that is that adjustment of the buildup in inventories that we saw in the second half of 2018, assumed to be disinvested, if you will, and that's going to create a bit of weakness in the GDP numbers for the first quarter and possibly the second. We think that we could get a 0.5 number for first quarter with the bias being to the downside.
This is for Dr. Omondumbi.
Sure.
What kind of policies are you reflecting in your bank in terms of approaching the lender or the borrower? How are you reacting to the economy at this point?
So we sent out a few surveys to our clients to get a view of what their reaction is towards hiring, the raw material prices, and so on. What we're seeing is that a lot of folks are pretty much taking a wait-and-see approach. You know, so a lot of folks know we're in the latter stages of the expansion, but they're being a little bit more patient, trying to get more data, trying to see what's going on a macro level before expanding or making new moves at this point.
Hi, thank you, Brian Paul from Daimler Trucks. A couple of questions for the panel, one for my own historical learning. I know that after the 2008 financial crisis, there was a ton of quantitative easing. That's, of course, trying to pull that back now. My question is, what happened to those dollars? I would have assumed we would have had a lot of inflation as a result of that, and we never did. And then my second question is more a future outlook. One of the things we didn't talk about today is debt. Government, basically, we're at unprecedented debt levels, $23 trillion. I've heard that there's a debt crisis within student loans. There's some concern in the auto industry with auto loan debt. So I just wanted to get your opinion on both of those topics. Thank you.
Yeah. Silence ensues again. Okay. Okay. I'm going to duck on the first one in this sense. Inflation is always and everywhere a monetary phenomena. And I think I'm quoting, maybe misquoting Milton Friedman. Where did the money go? It didn't turn into inflation, as I think the last 10 years have shown. Sam used to work for the Fed, so I'll let him answer that.
I agree
No.
totally with Jim.
It's
Jim, let me save you a little bit of
Angst.
stuff on that. As Jim said, inflation is all monetary. The problem, I think, was more psychological, that although the wherewithal for spending was there, the phenomena was so intensive, so pervasive, and so scary that the public basically didn't spend it. It was very similar to what Keynes used to call the liquidity trap. And so that's part of it. If you want to, I think there are two other things that were working out that did not transfer into more inflation besides that. And what I just mentioned was the most important. Part of it is that the world has changed. We are no longer in a world of taking things for granted, but the whole pricing system, the whole marketing, the whole chain is much more sensitive to demand. So prices were not automatically raised simply because you thought the demand was there, and we've all experienced it. Sales take place immediately and stuff like that. So the price pressures weren't there. So I think those two would be the most important ones of why it didn't manifest itself.
Let me take a stab on your second question, the debt question, which is debt is never a problem until the day that it becomes a problem. In a way, our experience with a highly levered economy in the middle years of the last decade, where credit was easily available, credit was extended, credit was overextended in the housing sector. We had as long as we had growth and as long as we had confidence, right through 2005, 2006, and into 2007, everything was just fine. But then the day comes, and whether it's a psychological phenomena, whether it's an economic phenomena, but the day comes that you start to get some head scratching and doubt and some worries about the quality of that debt. And you start to see some of the smart money pull out. And then all of this, and perhaps you have a growth stagger. You know, leveraging is fine as long as you're growing. Leveraging is not so fine when the leveraging becomes either so great or the growth stops, and the gravy train starts to end. So I think, and I believe in the last week or two, Martin Feldstein, wrote a op-ed piece in the Wall Street Journal that basically said this train someday will stop running, and it'll stop running on that day that doubt starts to creep into financial markets about the solidity of U.S. government finances, about the fact that debt can't continue forever. And I can't tell you whether that day is next year or in 3 years or 5 years, but if we get a nasty combination of over-leveraging, and maybe, we're on that train track right now, and we get a coupling to the recession, that day that, maybe U.S. government securities, turn into a junk bond. Please, don't say that ACT Research, is talking about treasuries turning into junk bonds. That is not what I'm saying. What I'm doing is I'm fancifully speculating on what would be a day of infamy out there somewhere, maybe, but that's the risk. And I would recommend that you, if you have your old Wall Street Journal papers, if you're a baby boomer, or if you're closer to that Gen Y or Gen Z, you can probably go fetch it electronically. It's interesting reading.
Just to say something about that, let's play a mind game. Imagine to yourself somebody has finished high school, scored the 4-point G, goes to college, goes to medical school, finishes internship, and now comes to you, you're all bankers, and wants to borrow money for to buy a house. Is there anybody here that would lend money to that individual? Raise your hand. Or let me do it this way. Is there anybody who would not lend that person money to buy a house? And we'll say it's a starter house, $200,000, something like that. How come? Here's a person, doesn't have a job, doesn't have any history of working or except for part-time, has no assets, and you're willing to lend him money? The person who asked the question, stand up. Come on. Would you be willing to lend that person the money? Why?
Well, because of the potential that they have for their income.
There you go. So the point is, it doesn't matter if the U.S. debt is $1 trillion, $10 trillion, or anything else. It's the ability or the perception of paying it back that's the important part. And as long as we have confidence in the U.S. economy, we have confidence in the institutions that run that, it doesn't matter what it is. It's when, as Jim said, once you begin worrying about will they pay it or not, that it becomes a problem. And the Congress always has the option to, as Jim pointed out, reducing taxes. They have the option of raising taxes to pay for these things. Or, as some of the people talk about, cutting the services of the government to different groups. It's only when it's politically expedient, and that's why September, I think, is going to be a fun time for all of us, or the inability of that institution to cover, that becomes a worrisome thing. Until then, it's a nice cocktail conversation.
Jeff, I think you got the last question, but we have an obligation to give short answers so we can stay on the agenda.
That's right.
Okay. Food for thought. In 2014, we had a polar vortex. The rail network was severely screwed up, and this lasted for quarters. We had some other odd factors, and we threw up a negative, 1.5% GDP number in the first quarter, followed by a couple 4% pluses in 2Q and 3Q. Now, I'm not suggesting that that's happening this year, but people don't shop and people don't spend when it's 40 below. And we did have a record amount of weather in the West. We've got severe flooding in the Midwest. The train systems are screwed up again. We've got other influence that you've talked about earlier, but could we be underestimating a weather-related delay in economic activity, negative to 1Q, positive to 2Q, 3Q?
Gentlemen, short answer, 3 sentences.
So there could be an immediate impact from, due to the extreme weathers, but over time, economists are usually more concerned by what happens like 3 months or 6 month averages. So over time, the true trend would prevail. Sorry, that was more than 3 sentences.
Yes, but only a small amount.
Yes. Thank you, everybody.